Worst news for Main Street. November unemployment report was published this morning. A Dow Jones survey of economists predicted 440,000 new November jobs. Is it the real figure? 245,000. A tremendous miss. In this way, our profound disbelief in the crystal view of experts is confirmed again. Overall, a disappointing report, the economists at Jefferies said, explaining. With COVID cases surging again and policies being put in place to try and slow the spread, hiring has slowed down. Also, worker availability is a significant limiting factor as well, with many unable to go to work due to COVID concerns or family care obligations. Today's report is a clear reminder that we are not out of the woods yet, adds Daniel Zhao, senior economist at Glassdoor. Even with a vaccine on the horizon, he continues, many are preparing for a long winter ahead. Just so, still, Wall Street is getting ready for winter in the tropics. The drenched sunshine strolls by the pool and sips frozen drinks. Dow for the 1,000. Earlier today, a CNBC headline. Dow broke a record more than 200 points, even after a major US jobs report was missed. The Dow rose 248 points to a record 30,218 at the closing whistle. S&P broke their new record, ending the week at 3,699. Dow, next stop 40,000. Reads another headline from financial idea generators. Would you believe in March? Meanwhile, CNN's Fear and Greed Index reads 88 out of 100. More than 75 readings flash as excessive greed. And with a metric, the Schiller's Cape Rate, stock market valuations are loaded into what our former colleague David Stockman called the nosebleed episode of history. Dr. Schiller's Cape Rate is currently 33. What is the historical mean? 16. Only 3 instances in United States history surpassed the Cape 30, just before the crash on 29, before the 2000-2001 dot-com blood flow, and in 2018. Never before had the stock market soared above the economy that supposedly supported it. Was the stock market surprised because it underestimated the future? So, because there are points that clear the economic air in front of you. Well, can we look at the satellite images, please? We are far from being convinced that it exists. Meanwhile, widespread deadlocks are possible as the virus sparks in rebellion, and the economy could go into recession this winter. So why did the stock market hit a record high once again? Zero ratios and not just QE. You are aware of the Federal Reserve zero interest rates. You are aware of how his wildly inflated balance sheet and how the goose markets merge. Still, have you considered the stimulating effects of the M1 money supply? The M1 money supply, cash, coins, checking accounts, travelers' checks, demand deposits, is the most liquid money supply. The M1 money supply has become 44% gross since March. Let exhibit as set a record crafted in October when the figure was 40%. Still, the great flood of money was pushed away from the real economy. For example, the consumer price index rose by only 0.5% in the same area. To highlight, the money supply has increased wildly, 44%. Still, prices hardly increased. Where did the flood waters flow? Of course, you know the answer. Assets, assets and assets. Mr. Howard Wang of Convoy Investments, while it can seem like the lack of inflation gives the government a free pass to print, the printing is not without consequences. The money is flowing through the higher financial inflation. the 40% increase in money supply didn't go into the real economy, but sloshed all around the financial markets. More money chasing fewer assets means higher prices, and vice versa. This year has been an extreme example of how, if you print enough money, you can increase asset prices under virtually any circumstance. We believe there is justice as a result. Meanwhile, Dr. Jeremy Siegel is professor of economics at the renowned Wharton Business School. He also credits the flooded M1 money supply. I don't just mean the reserves added by the central bank. I mean the M1 money supply, which has increased 44% since the beginning of March. We haven't seen this since World War II. World War II ended 75 years ago. Three-pronged policy. Yet, according to the Federal Reserve's own admission, the monetary and financial authorities have been following a policy course for the first time in 90 years. It's a three-way policy. The United States Treasury forms the number one roof. He emptied the $3 trillion financial booster through direct payments and loans. Prong number 2 is the Federal Reserve's 0% interest rate. Prong number 3 is the quantitative expansion of the same Federal Reserve for roughly $3 trillion. Combine one with the other two, and what do you have? You have the Dow 30,218. You have the S&P 3,699. You have the Nasdaq 12,664. United States stocks have risen 56% since March. In particular, technology stocks increased by 73%. Still, stocks are not the only asset in the rising tide. Cryptocurrencies stand even higher in the water. Bitcoin up 217% since March. Litecoin up 131%. Ethereum a dizzying 362% increase. Are we witnessing another cryptocurrency bubble? Said Howard Wang. The combination of massive printing and historically low rates is producing bubble-like behavior in many markets like cryptocurrencies. Much like in 2017. Of course, in 2017, the Fed began to withdraw liquidity and crushed many of those asset bubbles. The problem with bubbles. Will the Federal Reserve start withdrawing liquidity in 2021? We do not believe this. The economy requires a lot of irrigation. Liquidity will continue to flow into stocks, cryptocurrencies, and other assets. However, the bubbles will only expand a lot, and so the Federal Reserve finds itself in a corner. Drain the liquid, and the stock market drains with it. Keep flowing, and the bubble swells to obscene sizes, causing a massive fire. Well, what can you expect from the stock market in 2021? Will the bubble continue to expand or not? Citigroup operates a market oracle labeled as the Panic Europhia Indicator. When the panic spreads and the streets are full of investors' blood, the odds are perfect. The next 12 months will bring positive returns. Under enthusiasm, the dynamic reverses. When the spirits rise and the gods are down, chances are excellent. The next 12 months will yield negative returns. So, what are your chances of making a profit in the stock market in the next 12 months? Citigroup's chief US equity strategist, Tobias Levkovich, current euphoric readings signal 100% probability of losing money in the coming 12 months if we study historical patterns. So, not 56% probability, not 77% probability, not a 99.9% probability, but 100% probability of losing money. Happy investments. Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.